Welcome to the deep dive. Today we're getting into something really key if you're looking at automated trading.
Yeah.
Robots, algorithms, specifically risk management.
Yeah, super important stuff.
We've gone through a document called Risk Management in Automated Trading, Strategies for Low Drawdowns from Faida Ventures LTD. We're pulling out the really crucial bits for you. Think of it as a quick guide to protecting your capital with these systems. Our goal here is pretty straightforward. Unpack the main ways this source says you can limit those drawdowns, those dips in your investment value.
Exactly. And, the appeal of automated trading, that set it and forget it idea, is strong. But this source really stresses right from the start that risk management isn't optional. It's fundamental.
Fundamental for success in protecting your money.
Absolutely. It's the bedrock for actually making this work long term.
Okay, so let's zoom in on drawdowns. You mentioned them. The source emphasizes keeping them low. Can you break that down a bit? Why is that so critical for, the listener?
Sure. So imagine your account hits a new high. A drawdown is any drop from that peak value. And the source points out that keeping these drops small, keeping drawdowns low is vital, especially when the market gets volatile.
Right, keeps the portfolio more stable.
Exactly. Big drops, they take much longer to recover from. It's like a small stumble versus a big fall. Much easier to get back up from the stumble.
Makes total sense. So how do these automated systems actually manage the risk? The source mentions some clever algorithms are involved.
Yeah, that's one of the key mechanisms. These algorithms, they're described as kind of tireless watchers. They're constantly monitoring the markets, looking for early signs of trouble, adverse movements.
And when they spot something?
Well, they can automatically adjust things, like how much capital goes into a trade, that's position sizing, or where your stop-loss orders are set.
Stop losses? Those are like the eject button on a trade going bad. Closes it out at a certain loss point.
Precisely. The source really highlights these as, essential safety nets. They stop small losses turning into big, damaging drawdowns. And they can also help lock in profits if the market suddenly turns on you.
Okay. The document also talks about diversification, spreading things out, I guess.
Yeah, not putting all your algorithmic eggs in one basket, so to speak. The source explains that these systems can run multiple strategies across different markets, maybe different currency pairs.
So you're not tied to just one market trend.
Right. You're spreading the risk. If one strategy or market isn't doing well, others might be. It smooths things out.
Now, there was something called high watermark metrics, and a specific number, 30%. What's that about?
Yeah, that's interesting. It's about aligning incentives, really. The source says performance fees, what you might pay the provider, are only charged after your account significantly surpasses its previous peak, by 30% in this specific example.
Okay, so they only really get paid well if you make substantial gains first.
Exactly. It ties their success directly to yours, and importantly, makes managing risk a shared goal. They don't want big drawdowns either.
Got it. Let's circle back to position sizing. You said the algorithms adjust it dynamically. What does that actually look like?
Well, it means the amount of money put into each trade isn't fixed. It changes based on market conditions. The source explains that when things look uncertain or volatile, the algorithms will likely use smaller position sizes.
To limit potential losses if things go sideways.
Precisely. Smaller bets in rough seas. It's a core risk control tactic.
And technical analysis plays a role too. Things like moving averages, RSI. For someone maybe not deep into trading charts, what's the takeaway?
The main point, according to the source, is that these tools help the algorithms, let's say, confirm market trends, get a better read on momentum. Is the market overheated? Is a trend genuine? Using indicators like RSI or moving averages helps improve the timing of trades.
Better timing for getting in and out.
Yeah, leading to fewer losing trades entered on false signals, which, ultimately helps keep those drawdowns lower.
Okay. And this source finishes by saying, this whole risk management thing, it's not a one-off setup, it's continuous. Why is that so important to stress?
Because markets change
Yeah.
all the time. What works perfectly one month might struggle the next. So the source emphasizes that you, or rather the system, needs ongoing monitoring. Strategies need tweaking, adapting to new market behavior. It's never really done.
Constant vigilance.
You could say that, yeah.
All right, so let's quickly recap this deep dive based on the Faida Ventures material. The big message seems to be, risk management isn't just nice to have in automated trading, it's absolutely central.
Definitely.
And strategies like these smart algorithms constantly watching, diversifying your trades, adjusting position sizes dynamically, using those crucial stop-loss orders, and layering in technical analysis, they're all key pieces for keeping drawdowns in check.
They'll work together.
Hopefully this gives you, our listener, a much clearer picture and maybe a bit more confidence navigating this space. It's about understanding the core protective measures. And maybe a final thought to leave you with, think about how this intense focus on proactive risk management in automated trading, really focusing on protecting the downside, could apply elsewhere in your financial life. Is managing potential losses just as important as chasing those potential gains in other areas too? Something to chew on.